Lean in. It's Saturday, February 28th, 2026. Markets are closed, but the weekend news isn't. And when markets reopen on Monday, this won't trade like a normal headline scare. This trades like a bottleneck shock. Not financial advice. This is scenario analysis, market structure, and risk mapping, okay? Now, here's what's going on in plain language. Reports say the United States and Israel launched strikes on Iran. Iran responded, and Iran is signaling, in one form or another, that the Strait of Hormuz is not safe, or even closed. Whether it's fully closed in practice or not doesn't matter at first, because markets don't wait for perfect confirmation. Markets price fear. Then they price logistics. Then they price inflation. Then they price earnings. So if you want to understand what happens next, you don't watch the stock index first. You watch the pipes. You watch the ships. You watch the insurance. And you watch the second-order effects. Let's build the map. There are 5 transmission channels. Channel 1, energy flows. Channel 2, shipping, insurance, and freight. Channel 3, inflation and central banks. Channel 4, risk appetite, volatility, and credit. Channel 5, FX, the safe haven trade, and who wins the currency shock. We'll go through them slowly, and then we'll talk about the watch list, commodities, sectors, and specific companies that typically react. All right, Channel 1, energy flows. The Middle East is not just a region. For markets, it's a set of valves, and the Strait of Hormuz is the biggest valve on the planet. Roughly a fifth of global oil supply moves through that narrow passage. And it's not only crude, it's refined products too. When that valve looks threatened, oil doesn't need to be physically missing yet for prices to jump, because the market starts paying for the possibility. And here's the key concept. Caution becomes disruption. If ship owners slow down, if charterers hesitate, if traders pause liftings, if insurers reprice the route, then supply is effectively tighter, even if the wells are pumping. That's why this matters right now, because reports already describe tanker owners, oil majors, and trading houses pausing shipments through Hormuz, and LNG tankers slowing down, turning around, or stopping near the area. So the market isn't just pricing war, it's pricing delivery risk, and delivery risk equals a risk premium. Now, what does that mean for oil prices? There are basically 3 regimes. Regime 1, a short, sharp panic premium, maybe a gap up, and then it fades if shipping continues normally. Regime 2, a sticky premium. If the conflict continues and shipping is uncertain, oil can hold higher for weeks. Regime 3, a supply shock. If Hormuz is materially impaired in practice, even temporarily, the market starts pricing extreme outcomes. That's when you see talk of triple digits in oil, and that's when the entire macro regime can shift. Okay, Channel 2, shipping, insurance, and freight. This is the part most people ignore, and it's the part that turns an oil move into an everything move. Because oil is moved by ships, and ships move when they're insured. If war risk policies get canceled, or premiums jump, or underwriters say, "We'll cover it, but it will cost you," and terms are tighter, then the cost of moving energy rises instantly. And in extreme cases, ships simply refuse the voyage. This is why you'll hear a lot about war risk premiums, charter rates, and advisories. And there have already been reports of insurers planning cancellations and higher pricing for ships moving through the Gulf and Hormuz. That's not just a shipping headline. That's the beginning of inflation transmission. Because shipping cost is a tax, not a government tax, a chaos tax. And it hits energy, chemicals, plastics, fertilizers, food logistics, and consumer goods. So if you want to tell for whether this is escalating into a sustained market event, watch the insurance language. When insurance tightens, the market impact lasts longer. Okay, Channel 3, inflation and central banks. This is where the market starts arguing with itself, because in the first 24 to 72 hours, you often get a classic risk-off move. Equities down, volatility up, safe havens up, And sometimes bonds rally because fear bids sovereign debt. But if oil stays elevated, that's inflation, and inflation changes rate expectations. So the question becomes, is this a one-week shock or a one-quarter macro problem? If it's 1 week, the market can look through it. If it's 1 quarter, then earnings estimates change. Margins change. Consumer demand changes. Central banks may stay less dovish, and the sectors that suffer are the ones that can't pass costs through. This is why oil shocks are often described as stagflationary risk, slower growth, higher prices. Not always, but that's the fear. Okay, Channel 4, risk appetite, volatility, and credit. When a geopolitical shock hits on a weekend, the first real trading day can be messy because liquidity is thinner at the open. Spreads widen, stops get hit, and the tape can look irrational. So here's the whisper part. Don't confuse volatility with information. The first move is not always the real move. Typically, you get gap, spike in volatility, sector dispersion, and then the market decides if the shock is containable or persistent. Credit spreads are a big tell, because equity can bounce on hope. Credit is more stubborn. If credit starts to widen meaningfully, the market is telling you this might not fade quickly. And watch volatility measures. If vol spikes and then vol of vol stays high, that's a sign the market expects more surprises. Okay, Channel 5, FX and safe havens. In global shocks, capital runs to perceived safety. Often that means US dollar strength against many currencies, Japanese yen strength, Swiss franc strength, and gold tends to catch a bid. But there's a nuance here. The US is a net energy exporter, so if oil spikes and stays high, the dollar can be supported relative to other import-heavy currencies, even if the US is directly involved in the conflict. Now, crypto? A lot of people still think Bitcoin is a war hedge. In practice, lately it's traded more like a risk asset. So don't assume it will behave like gold. All right, now that you have the map, let's talk about what most people came for. What happens to the market? What happens to commodities? And what happens to specific sectors and companies? We'll start with commodities because commodities are the first domino. Commodity 1, crude oil. Crude is the headline barometer. If Hormuz risk is perceived as serious, oil can gap higher. But it's not just crude. The real pain shows up in refined products. Commodity 2, refined products. Diesel and jet fuel can move aggressively in conflict-driven energy shocks because refining capacity and distribution bottlenecks matter. This is where you sometimes see airlines get hit twice, first by fear, then by jet fuel costs. Commodity 3, LNG and natural gas. This one can be the sleeper, because Qatar is a major LNG exporter, and LNG cargoes are very route sensitive. If LNG tankers slow or divert, European and Asian gas pricing can react fast. Commodity 4, gold. Gold is the classic, I don't want to think, asset. It tends to rally on immediate fear, especially if investors lose confidence in the near-term outlook. Silver can follow, often more volatile. Okay, now equities. The broad market, S&P, NASDAQ, global indices, usually take a hit in the first reaction. But the real story is sector dispersion. Some stocks go up hard while the index is down. So let's categorize. Category 1, potential relative winners. Number 1, energy. Energy is the obvious first-order beneficiary of higher oil pricing. But there are different types of energy exposure. Integrated majors often act like oil beta plus dividends. Upstream producers often have higher sensitivity to oil price moves. Oil services can benefit later if higher prices persist and capex rises, but that's more lagged. Examples you'll see traders watch in the U.S. Exxon, Chevron, Shell, BP. Upstream names like ConocoPhillips, EOG, Occidental. Services like SLB, Halliburton, Baker Hughes. In Australia, traders often watch names like Woodside and Santos when oil and LNG move. But a warning, in real conflict, even energy companies can get whiplash, because the same event that lifts prices can also disrupt operations, shipping, and costs. So energy can outperform and still be volatile. Number 2, defense. Defense is the other classic relative winner. Not because war is good, but because escalation increases demand expectations. Munitions replenishment, air defense, surveillance, logistics, and procurement urgency. In the U.S., watch lists often include Lockheed Martin, RTX, Northrop, General Dynamics. In Europe, BAE Systems, Thales, Leonardo. Again, not recommendations, just the usual tape behavior. Number 3, select cybersecurity. Conditional. If the conflict escalates into cyber retaliation, markets sometimes rotate into cybersecurity names on expectation of rising spend. But that's headline-driven and can be choppy. Okay, Category 2, likely losers. Number 1, airlines and travel. Airlines are exposed to jet fuel, route disruption, airspace closures, and demand shocks. Even if nothing else changes, oil up usually means airlines down. So watch lists include Delta, United, American, Southwest, plus large global carriers. Travel platforms, cruise lines, and hotels can also get hit, especially if the news flow scares consumers. Number 2, consumer discretionary. If energy prices stay elevated, it's like a pay cut for consumers. Gasoline, heating, transport costs rise, and discretionary spend can get squeezed. Not instantly, but if the move persists, the market starts pricing it. Number 3, industrials with heavy freight sensitivity. If shipping costs rise and insurance tightens, companies that move a lot of physical goods can see margin pressure. Okay, Category 3, mixed and complicated. These are the sectors where the headline reaction can be wrong. First, refiners. Refiners can go either way. Higher crude can be a headwind, but if refined product prices rise faster than crude, refining margins, crack spreads, can widen. So refiners like Valero, Marathon Petroleum, Phillips 66 can behave differently depending on product tightness. Second, tanker shipping. Tanker day rates can surge in crisis because routes change, voyages get longer, and available ships shrink. But the operational risk is also high. If the route is too risky, ships don't sail. No sailing, no earnings. So this is a high volatility segment. Third, defense suppliers and component makers. Primes benefit from contracts, but supply chains matter. Electronics, propulsion, materials. So the second-order winners can be inconsistent. Okay, now let's talk about the Monday open mechanics. Because if you're watching this right before the reopen, you need to understand the behavior. Expect gaps. Expect violent rotations. Energy up, airlines down, defense up, high beta tech down, at least initially. But also expect head fake rallies, because some players will fade the panic if they believe it de-escalates. So here's the whisper rule. Don't trade your emotions at the open. Let the first wave pass. Let price discover. Let spreads tighten. Then watch what holds. If oil spikes and holds, if shipping headlines worsen, if insurance tightens further, that's when the market starts pricing persistence. If oil spikes and fades quickly, and there's evidence ships are transiting normally, that's when the market can snap back. Okay, now the 3-switch dashboard. If you only remember 3 things, remember this. Switch 1. Is Hormuz open in practice? Are tankers moving? With insurance? Without major incidents? Switch 2. What does OPEC Plus do? If there's a credible supply response, it can cap the panic. Switch 3. Does it spread to infrastructure? gas fields, export terminals, pipelines, power grids. When infrastructure is hit, the shock becomes real, not theoretical. All right, now let's make this actionable without being advice. What can you do as an investor or trader? First, audit your exposure. Not your opinion, your exposure. Ask, which holdings benefit from higher oil? Which holdings are hurt by higher oil? Which holdings are hurt by higher freight and insurance? Which holdings are dependent on consumer discretionary demand? Second, respect volatility. When volatility rises, your normal position size becomes bigger risk, even if your dollar amount is the same. Third, don't fall in love with a narrative. This will be a headline war and a liquidity war. The tape will punish certainty. So focus on the mechanism: energy flows, shipping, insurance, inflation, central bank expectations, and credit spreads. Okay, let me close with a calm summary. This is a geopolitical escalation that markets will price primarily through energy and logistics. If shipping is stable, the risk premium can fade. If shipping is uncertain, the premium can stick. If shipping is disrupted, it becomes a macro event. Watch oil, watch LNG, watch insurance, watch OPEC+, watch credit. And remember, the first move is not always the real move. Psst, stay calm, stay liquid, and stay focused on the map, not the noise. Stay calm, stay sharp, and take care of yourselves. I'll see you on the next video.